we invest in a kind of asset class where we feel that some big changes will happen in the next years. So typically like digitalization of the economy, decarbonization of the industry also. You have also demographics. I mean, thanks, the population is getting older. And there are new needs, especially in social infrastructure, which are, by the way, links to mobility and also energy. Potentially, then you have also a fourth, we say trend, with this kind of evolution of the geopolitics. This is why we call it the 4Ds now: demographics, decarbonization, digitalization, but also deglobalization.
Thibault, many thanks to be on Aulium.
Good to be there.
So Thibault, you spent your career in and around infrastructure, first advising on some of the biggest deals in banking, and now investing directly as a managing director in UBS Infrastructure Private Equity team. You focus on the hidden assets that really shape our daily life, from fiber networks and data centers to renewable energy and transport. What's really fascinating is how you bring together the hard-nosed finance side with a real interest in sustainability and decarbonization. I'm quite excited to dig into how you see infrastructure evolving and the role you believe it plays in building the economy of tomorrow. So maybe to kickstart the discussion, would you mind giving us a bit of details on your own sort of career path, which led you from investment banking to infrastructure investing, and maybe explain how the transition took shape and how you think about this today and what you focus on, etc.
So thanks, Thomas, to receive me and to host this podcast. I mean, I started my career in Mexico City. I mean, after my studies in finance, in business school in France, in the UK, I had an internship at BNP Paribas in Paris, and I had the choice to choose between what we call like a VIE, so it's kind of a 1.5 year like program for young professionals. I could choose between London, Frankfurt, Mexico, and Tokyo. And I chose to go to Mexico because there was a one director and me to cover all South America except Brazil. And so I had like the chance to work on deals in Honduras, Salvador, Bolivia, and Mexico. It was pretty appealing when you are 20, 22, 23 years old to be in those geographies. Then after I joined Rothschild in Paris and the investment bank in the M&A team, where I focus on emerging markets, but also on French transactions. Then after I worked for Morgan Stanley in London, so I decided to cross the channel to join in London in 2010. And there I will start to work more on infrastructure deal, working in Europe for European clients, such as strategic investors, but also corporations, mostly in energy and renewable space. And then I worked for Nomura in London, the Japanese investment bank, where I was working in M&A and transaction with a focus on infrastructure. And when you work on M&A, I mean, there's always like a deal origination, deal execution, I would say, purpose. But your kind of objective is to make make deals. So either on the buy side or on the sell side. So you don't really care if it's a good or bad deal because your job is not to judge if it's a good transaction. Your job is to make it happen. So it's why maybe it's what I was lacking in terms of career. Like try to be more like involved in the ownership of the transaction. What you mean when you invest in the company, you live with it, you try to live with it, you try to develop it, but you're not just like a broker. So it's why I decided to join UBS Asset Management in 2017 in the infra equity private equity team. Where I'm involved in all the origination, execution, but also asset management and fundraising for the business. So the whole purpose of this was like to have like probably like a broader and more complete role where you're not involved in doing deals, but involved in the structuring of the transaction, involved in the legal aspects of this transaction, but also try to make sure that the business plan and your strategy align with what you want to invest in.
Okay. And so what about like the transition? So you just said that M&A is more oriented towards having deals go through the door, and you actually don't really care in some way if it's a good one or a bad one. You just want it to be executed. Once you go on the other side and you need to be a bit more critical on the companies you look at, how did you switch your mind from, being super positive, everything is going to go well, to another mindset where you are trying to assess risk and challenge the companies, challenge the management, etc. But it's a bit of a different sort of mindset and nature, I guess.
That's true, Thomas. And to be completely frank, it took me probably a year to adapt from a M&A role to an investment role, because I mean, you have a lot of reflex. As you said, everything is great. Everything is kind of positive for an asset that you want to sell or to buy for your clients, where you need to live with the assets once you have acquired it. So it's completely true that I think that what is very important is like when you assess an opportunity, you assess the pros and the cons of, and try to see if the cons are kind of red flags and compensate, I would say, the willingness to do a transaction. So that's kind of the first thing. Second thing, I mean, you need to understand that if a transaction or an asset that you assess is in line with your strategy, because I mean, you can have different risk profiles, you can have different, I would say, returns profile also. So I mean, when you have some guidance and you have to follow a strategy, you need to be a bit disciplined here to make sure that you're not wasting your time in something that, even if you think the deal is interesting, it's not part of your mandate. So, I mean, in terms of, to answer your question, in terms of mindset, you need to be kind of defensive in terms of your approaching. So, what what could go wrong? What's kind of the worst
Mm.
case scenario? Is it acceptable? Is there like some kind of mitigants to those kind of worst case scenario? But also, you need to see what are your upsides, because I think at the end of the day, you're trying to buy an asset, a situation where you're not going to overpay. So you need actually to see like, okay, I don't want to overpay, and this is my defensive case, especially in infrastructure. But what are the growth avenues where I can get my alpha? And hopefully, if things goes well, and if we manage to implement the business plan, this is probably where we are targeting to go.
Okay, understood. So maybe if we dig into like the infra world, so how do you essentially see the entire landscape? I mean, what sort of sectors and themes are you personally most drawn to today? And if you could explain why, would be quite interesting too.
Yeah, sure. When you perceive infrastructure as an asset class, you need like to think as a kind of macro and secular trends. I mean, we invest in a kind of asset class where we feel that some big changes will happen in the next years. So typically like digitalization of the economy. I mean, this is happening. Decarbonization of the in the industry also. I mean, trying to go more electrical and less carbon positive. You have also demographics. I mean, thanks, the population is getting older. And there are new needs, especially in social infrastructure, which are, by the way, links to mobility and also energy. And potentially, then you have also a fourth, I would say, trend with this kind of evolution of the geopolitics. You will see a lot of industries coming back to home countries. I mean, you see that with microprocessors, you see that with data centers, you see that with a lot of kind of industries where some of the Western countries want to get the industry back in the country. So it's why we call this the 4Ds now: demographics, decarbonization, digitalization, but also deglobalization, where we try like to focus a bit our investments. So I mean, I would say that we probably have 3 or 4 verticals in infrastructure. So you have the digitalization, so investing in fiber, data center, tower telecoms, but also all the adjacent of digitalization. You have decarbonization or energy transition, which is all the energy player, but also you have all the kind of other transformation like recycling, especially plastic recycling, which are growing more and more. You have mobility, so transportation, which is something which is growing. So it would be like airports, it would be toll roads, it could be rails, which is kind of also like transforming a bit our lives, but also you see like some so huge transformation play here. And you also have some social infrastructure also, which kind of another bucket that some investor invest, which are kind of home cares. It could be like some healthcare facilities, which is also like kind of developing with a more aging population. So, I mean, what's key for the investor in infra is kind of, it needs to be an essential service. It needs
Mm-hmm.
also like to limit there needs to be some limits in terms of competition. We try to find like, some assets where, I mean, there are not a lot of alternatives. What is important also is kind of the visibility and the cash flow. So it means that usually you have some pretty well contracted features, often inflation linked, which provide like to an investor like an infra play some kind of comfort that the business has some kind of solid roots. That's why I'm also like we don't invest compared like to pure PE funds in only services. Having said that, I mean, the industry is changing, but we invest in assets where we feel that it's what we call asset heavy. That's something that creates some barrier to entries because not everybody can pop up and build like a toll roads, for instance, in a region.
So yeah, it's true that the sort of distinction between infra investing and traditional private equity is becoming more and more subtle. So how do you balance maybe in the different projects you see and your portfolio, what we would call like classic core infrastructure with maybe more growth-oriented plays like the ones you just mentioned? How do you balance those two, and when do you say, okay, that's too much for us as
Uh,
investors? That's more for the traditional private equity guys. We're not going to look at this because if you follow a bit the, let's say, like the risk reward curve, I mean, there is not a moment where it says, okay, you are on the other side. I mean, it's somewhat subjective, I guess.
Yeah, no, that's a very fair point. It's a whole debate. I mean, you mentioned core plus or value add. I mean, those kind of are the kind of definition to kind of classify the infrastructure fund in some kind of risk profile. Yeah, risk return profile. I mean, those definitions change every year. So I mean, there's always a debate: is it core plus? Is it value add? Is it core, etc.? And especially with the higher interest rate environment, I mean, the core areas have to increase a little bit in terms of returns because otherwise it would make more sense to buy treasury bonds rather to invest in infrastructure assets. I think that's when you invest in infrastructure, you follow a strategy. You need to be disciplined. You have to choose a bucket. Are you core? Are you core plus? Are you value add? Are you a mix of the two? But when you're going to raise some capital, as we do from third-party investors, or pension funds, insurance companies, family offices, sovereign wealth funds, I mean, they need to understand what you're going to do. So
Mm-hmm.
if they don't understand what you do, if you're doing like a P strategy or you're doing a real estate strategy or a VC strategy, I mean, they're going to put money in a VC fund or in a real estate fund or on a P fund. They're not going to put money in an infrastructure fund. So you need that to follow kind of this strategy and stick to it and have this kind of discipline that if the asset that you could be considering is not in this strategy or is in another bucket, don't follow it. Having said that, I mean,
There are
the
exceptions.
sum of yeah, there are exceptions because I mean, let me give you an example. For instance, if you invest in a data center, like for instance, like in Enterprise Colocation, so we have invested like, in an asset in the UK called Datum, and we have acquired like a first site in Farnborough near London. The following
Mm-hmm.
year, we acquired like another company in Manchester where we merged it. We are also building data centers, and we built one which is operating since this summer. We are building another one near Farnborough. So, I mean, here we're doing what we call probably a value add, I would say, strategy because we acquire like a first asset, we kind of develop it, we create some value by probably buying like some asset at a lower multiple, merging in with an existing entity, and hopefully the combination of both will have to create value, but also to create scale in order like
Mm-hmm.
at the point when we're going to exit we have built like another company. So that's kind of the purpose. So, I mean, when we kind of raise our third fund, I mean, we have like a core plus strategy. But at the end of the day, we started with a kind of core plus investment, having in mind that we could do the value add strategy because we have identified the right growth avenues. Now it's a question of creating this value, implementing this business plan in order like to get the extra returns that you were targeting. And that's kind of why we
Mm-hmm.
are being paid by investors. They pay fees, management fees, in order for us to create this value. So we're not going to be shy to create this value if we think it makes sense. And you have like kind of always in mind this kind of defensive case that you're not going to lose
Mhm.
your shirt, for instance. For instance, like to add to this kind of data center example, I mean, managed services, which is more like a techie part of the data center, is not something that you would consider for investor. It's more a P play. Having said that, I mean, there are some kind of, I would say, more techy, I would say, pieces of the data center which will help to retain some clients because you offer them other services in order like to limit the churn, so the fact that they may leave, and
Mhm.
in order like, to protect your infra investment. So you need to have like some kind of bit of common sense and kind of judgment here. Try to see like
Mhm.
maybe I will go like on more on the service part, which is not my field, in order to be able like to protect, I would say, my infra investment. So that's kind of a thing that you need to think about it. So that's kind of what we do in infrastructure. So being disciplined, follow your strategy, don't lose track a bit of what you're doing, and don't go like in other territories because it's
Mhm.
not your business. But I mean, now we are just like there's like some brainstorming of doing like a more next gen strategy, and some funds are doing
Yeah.
that where it's probably the frontier between PE and infrastructure. But it's interesting because I was having a coffee with a PE fund and I was looking at their portfolio, and some of their assets they have in their portfolio could have been like an infrastructure play because the problem
Mhm.
is like this is much more asset light, very services. But we're thinking, for instance, like they were like doing some maintenance on through sensors, okay, for pipes, which are an infrastructure play. And the idea would be like, can we like kind of develop this kind of metering or sensors like a more industrial way in order like to create like a more asset heavy, I would say, businesses which have like a connectivity piece because I mean all those sensors connect like through digital in order like to kind of create like an infra play. So typically you may want like to acquire a business with you feel like is P from day one, but if you have a plan to turn it as an infra player and to de-risk the business, could be that by extending the contracts, so you have like more visibility on the cash flow, more contracted capacity, make it more asset heavy by acquiring maybe some of the kind of the infrastructure in place. So it could be sensor, it could be like the walls of the business. I mean, this you may be able to create value and acquire a business at a higher IR and be able to sell it at a lower IR and do an arbitrage in terms of risk and returns on this
Mhm.
in order like to make like an interesting return. So those are kind of the thinking we're having. And it's interesting because it could go the other way on the real estate also. And what's a data center? It's a power play, but I mean you need to have the right location, so it's a real estate play, etc., etc. You
Yeah,
see
true.
that a lot with EV charging. So EV charging, it's kind of a power play because it's electricity, but I mean you need to have the right place and the right contractual feature that you may have with the real estate developers, but also it's connectivity because I mean those kind of EV charging need to talk to each other. You need also like to be able to retain your clients and understand also like the utilization rates. So
Mhm.
I think that we're going through like a phase where the frontiers between P, real estate, and infra are being more and more blurred. And I think like we are thinking like, for instance, like more like infrastructure connectivity, because I mean, power needs to connect to each other. Digitalization, fiber data center needs to connect. I mean, people and store data, but mobility also is going to be linked to a power play, but also to digital. So we think that even like all the kind of very separate verticals of infrastructure working together because I mean this is how our society is evolving.
Okay, that makes sense. Maybe like just to go back on the data center side of things. So it's obviously a big theme today. I mean, we don't spend a single day without hearing about AI and data centers. Would you mind explaining, let's say in simple words, the economics of a data center? I mean, how do you make money? So as an investor, do you invest you yourself, not necessarily in the land because you are not a real estate investor, but what do you invest in? Who will then
Yeah,
operate the data center? You mentioned growth with your own like data centers, your own. And what are the economies of scales and synergies you have when you develop maybe different locations, etc. I mean, if you could explain
yeah.
how it works, it would be absolutely cool and great.
Sure. So I mean let's me divide a bit the data center world in three buckets. I mean first
Mm-hmm.
and I explain a bit I mean the economics of each bucket and also like the risk and and returns of each project. So maybe the one that you see a lot of in the news is like what we call the hyperscaler data centers. So it's a data center which gonna consume a lot of power. We're talking about potentially hundreds of megawatts, and usually you may have like one, potentially two tenants. So it's going to be like Meta, it's going to be Microsoft, it's going to be like Amazon, and they gonna kind of need to have some very bespoke features. When I say bespoke features, I mean they typically like to operate their own data center. So what do they need here? They need like land. They need like some kind of shell. They need some kind of chillers to cool it. I mean they need kind of all the kind of um, power and kind of maintenance of the data center. Then after the rest,
Mm-hmm.
they will take care of it. So for this kind of large data center where you typically have a 15, 10 years contracts with a data center, I mean, you're going to look at kind of probably like big investment tickets. Could be some billions, depending on the size. You will need like to find like some like very kind of um, clear path to power availability. Because I mean, when you need to power like 100 megawatts, and you need like to either have like some kind of very contracted accessibility to power, or potentially create your own power plants. It's what you see also in the news, especially in the US. And for those kind of investment of data center, you're going to kind of lease, I mean, this kind of power access lands and kind of shell of data center to those kind of big hyperscalers. But I mean, as
Mm-hmm.
they're going to do most of the work and case by case, but they know exactly what they want to do, you won't expect to have a large return. So it's probably like more like almost like real estate territories. And it's why a lot of data centers for hyperscalers are kind of being are working with real estate investors, because I mean they
Mm-hmm.
see like as a large tenants, a single tenants going to stay there for 10, 15 years.
So
And
just
probably
just to summarize quickly, so I'm Meta, Microsoft, Amazon. I want to build like a very big data center. I will connect with real estate investors. They have a piece of land. They can build the actual buildings and the sort of racks for my servers. I will have some specific requirements, as you said, in terms of cooling, etc., etc. At the end of the day, me as one of those big firms, I'll put my servers and then I will do the rest. So it's more or less like, as you said, like a tenant. So I'm renting a place, and that's how it works.
So that's exactly that. So I mean, you can even put like infrastructure investors, but it's going to be like probably like more the core side of the business. Okay. And by
Mm-hmm.
the way, what we see is like you can lease those kind of large data center to hyperscalers. You create an asset
Mm-hmm.
co, which is almost like pretty stable cash flow over time because it's kind of almost fully contracted, and use this kind of asset co as leverage to develop further data center. You do like a dev co, and you're able like to kind of increase your returns by using those contracted, I would say, cash flow to finance the less contracted cash flow. So that's what we see. So that's the first bucket. And it's probably what we call core, let's say probably between 9 to 11% IR, depending on the contractual features and the geography. Then after you have what you call HPC data centers, so high power consumption data center, which are more what we call AI data center. So it means that probably it's going to be like smaller data centers who's going to consume like a lot of energy per rack. Because they need like to do like a lot of computation. So you can see the price of the GPU discussion. And those data centers, I mean, you make money by operating the data center. So you have an operating company, you're going to give them access to the power, to the cooling, and the security that they need. And
Mm-hmm.
they're going to probably like pay you like kind of a lease depending of the capacity they need to use. And probably they're going to be like a pass through in terms of the power, because the more power they use, the more they will have to pay directly. So you're not exposed to their power consumption. It depends on the case by case contract, because I mean that would be like too risky, because those are pretty high consumer power. For those data centers, you need like to kind of have a specific, I would say, features. For instance, like you have like liquid cooling, which are pretty expensive.
Mhm.
And also those kind of I would say AI or HPC clients. Often you see some kind of startups, so especially in the AI space. You don't have always like a very like credit worthy clients. So it means that you have some risk, and we've seen that in the Bitcoin I would say industry. A lot of Bitcoin miners like bankrupt. So
Mhm.
you have a risk here where you may have like a very specific data center with like pretty high spec features and potential to lose your clients. And also potentially they use a lot of the energy because by definition, this is what they do. So you need to secure a lot of energy. And as we know, it's a kind of complicated play. So the question mark you may have is like, oh, do I want to use all the energy I managed to secure for those type of clients, which could be at
Mhm.
some points risky. It's why you're going to expect like higher returns for those kind of investment. And we looked at fewer transactions, especially in the Nordics, where in the Nordics you have some kind of natural cooling, you have some space, you have energy is cheaper also there. So it makes sense
Mhm.
of those high power computing clients go there where the energy is cheaper because they need a lot of this energy. But at some point, they need also to be potentially near to the end client. So it's why, I mean, we see them also coming like to a more urban areas. So that's the second bucket. The third bucket is like what we call enterprise colocation data center. So it's going to be retail or wholesale. And this is like a part where we invested.
Mhm.
This is like a business where you own the data center, you operate the data center, you're going to lease some racks, and you have two types of clients. Either the wholesale clients, so it could be that kind of large clients, and it could be hyperscalers, by the way, but often it's media company or it's kind of a large institutions like from banks, could be also like police or hospitals, where it's going to take
Mhm.
like a large part of your racks and energy. And often, what you're going to negotiate with them is kind of a pass through on energy. So they're going to pay they're going to be called like metered clients. So it means you're
Mhm.
not going to be exposed to their power consumption. And you have a second part.
So part
The
of the
second,
price is
yeah.
indexed to the amount of energy they consume.
No, on this one, they will like have like kind of a fixed price, and after like they will like kind of yeah. Sorry, you're right. So they're gonna have a fixed price to rent. I mean the premises, and after you can make a margin potentially on the energy they consume. It depends on the contracting feature you have with them. Sometimes not. They
Mhm.
just want to have like fully passed through. So it's if the energy price go up and down, you're not exposed to this because you may have like a fixed margin on this. That's like the other type of clients, what we call retail clients. Those are smaller companies which needs like to have their servers that they used to have in the past, their server in their building, etc. Now they want to have
Mhm.
it in a data center because they want to be able like to have a bit more control and also maintenance for their. And typically for those enterprise colocation, and same thing for wholesale, it needs to be well of probably like roughly like 2 hours from your headquarters or IT teams because I mean they need like the teams needs to have access to their servers in order like to do
Mhm.
some fixings or connection, etc. So that's important. So it's why I mean those enterprise colocation data center you see them like not very far from urban areas, not in city centers often, but like around cities in order like to have a quick access. And for those retail clients, I mean this is interesting clients because you make money selling them some capacity on the fixed price. And often what you do is like, they're going to consume X amount of energy. So you're going to charge them on the maximum of energy they're going to consume. But at the end of
Mhm.
the day, they're probably going to consume half of this or sometimes a third of this. So it means that those clients probably make more margin because they're going to consume less energy. And you'll be able like to use the energy that you have, like for other clients who may use some energy. So you may be able to oversell some capacity for those clients, even if you don't have kind of the full energy at this right point of time. So, and often like for those enterprise colocation like clients, you're gonna do like probably higher margins. The good thing also is often you have like more clients. And the churn is roughly like 3 to 4%. I mean, at Day2, my data center in UK, we have more than 200 clients, and this helps us like to mitigate the risk. So you don't have the risk that you have like Meta in 10 years decide like to go somewhere else, and after you need to find a new tenant. Here, I mean, you have like those clients are here for a reason. They may go to the cloud, by the way, and go like for large data center, like to go to the cloud versus going on site. But also, I mean, we have also cloud clients in enterprise colocation and what we call wholesale. They are media
Mhm.
company or tech companies, and they are using a bit the data center in order like to host cloud clients.
Okay, understood. And so maybe can you elaborate on how that deal and projects in the UK came along? How did you source it? Was it intermediated? Any sort of competition? I mean, how did you see that specific space? Like maybe management. How was your first encounter with management, etc.? I mean, it would be quite useful to understand how it works out like a transaction like this.
Yeah, first, I mean, this deal was not intermediated per se. I mean, all
Mm-hmm.
the transactions that we've done in our portfolio, almost all, have been done through like bilateral discussions. Having said that, it's often like a small process at the beginning, but we managed to navigate and get exclusivity. That's a bit the way we do deals. Because I mean, we feel that going to long processes that potentially is a waste of time and money. And I think that with experience, when we like an asset, either we try to get it at our terms or either we walk away. It's very important, and we see that like not to pay the right price and not like to be like kind of taken in some auction process where people start like to be disconnected like to the intrinsic value of the asset. So that's very important. To come back to this data center, I mean, there was kind of a process organized by a small advisor who didn't really know what could be the type of investors. And the good thing is we're discussing another transaction with them. So when we heard about these transactions, so quickly we managed to talk to the management. I mean, the good thing also is kind of was a probably like a process a bit messy, and nothing against the company or the advisor. Is just like, I mean, they didn't have like it was owned like by the P fund in the past, so there was a bit of accounting kind of to be redone, etc. So I mean, the fact of having some kind of hairy process is a good thing, we think, because I mean, if we like the kind of the big picture of the asset, you may have less competition because people don't have time like to deep dive in an assets and they want like things to
Mm-hmm.
be kind of a bit more I would say tidy for them, so they can like provide like an offer. So I mean, on this one, for instance, we had to almost redo the business plan, hire an advisor to help us on this, which, by
Mm-hmm.
the way, creates some kind of goodwill with management. We had a lot of interaction. And also it helped us also to test management because, I mean, part of our due diligence process, we are buying not assets, but we are buying operating companies. So we have to make sure that management will deliver the business plan and also are good enough in order like to be able to implement the kind of growth strategy that we're going to implement. And we do that for all our assets. And we have lesson learned. We were disappointed by some management that probably we misjudged at the very beginning. And I think that's important that as an investor, we take some hard decisions if we feel that we don't have the right management at this right level of development of the company to be able like, to change it and people understand it.
Mm-hmm.
So that's a bit part of the due diligence we've done. So we managed to rebuild this business plan with the management. As the management will kind of run the business, the day-to-day business, and then they need to own this business plan also. So that was important also that they felt confident that they could deliver it because they're going to be part of the journey for many years. And also part of our due diligence was to kind of identify the growth area. I mean, we managed to see that there was some land around the data center we considered. We
Mm-hmm.
managed to also like to get some comfort that the power was available. There was a path to get the power available there. That's we worked on this in order like to identify the growth area. So I think when we perceive an investment, not only for data center, as I mentioned earlier, you need to have a kind of a defensive case where you have like very comfortable. There
Yeah.
could be like a crash test also, which is also interesting like to take into account. But also once you have like this kind of comfort, try to develop those kind of growth areas in order like to get your extra returns. So that's probably how we approach those deals. So avoid those auction processes, try to get some more like, I wouldn't say personal, but almost like kind of close contact discussion with management, get confidence that you're going to do something together. We're going to do something together, sorry. And also be kind of confident that we're going to be able like to grow the business together.
Okay. In terms of growth, so I asked a question earlier, but what makes it interesting, like to multiply sites, etc., in that data center business? What are the synergies you see by getting bigger?
So, I mean, if I take the enterprise colocation data center, which I mentioned earlier, where you have multiple clients, I mean, this is a very local business because indicated, I mean, you need like to be not very far from the data center. So it's why we tend to go in areas where there's some kind of pretty good industrial or service, I would say, network, because we know those clients, those is a potential for clients, new clients or existing clients. So that's important that you target the right area for your data center. It's not only the power, of course, it's important, but it's also like to have the right geography. There are in a country some synergy in terms of the sales force, because since if you take the UK, I mean, that you sell in Manchester, Farnborough, Newcastle, Glasgow. I mean, this is the same country, the same language. So, I mean, you can imagine that if you have the right sales force to find new clients, to take care of existing clients or grow existing clients, you can use your existing sales force. You can grow it, of course, but there's like some kind of very important synergies on this and be able to use this sales force to grow your business. But this is like not kind of probably as obvious if you go like to another country. So, for instance, if you're in the UK, you want to go to Germany or France, I mean, it's going to be a different sales force. Okay, there may be some synergy with management, but to be honest, as those markets are relatively local, management may understand very well their market, but not another market. So they may have like another perspective. So probably there are limited synergies if you're looking to other geographies. And it's why, I mean, when we are considering like other data centers, we see it like as another investment, not as a growing investment of our existing data center platform, because we know those markets are local.
Okay, understood. So you mentioned a lot energy multiple times, and so there is also that challenging ideas that more data centers equal more energy consumption equal more carbon in the atmosphere. Uh, so maybe can you explain how you see the sort of ESG aspect and how data centers like fits in the energy transition and decarbonization, because you mentioned it's also some of the big themes in infra. So how does the data centers fit in really? I know that there are
Yeah, no,
examples where you can, bundle different assets. So you recycle the heat for, something else. But generally speaking, for you and your team, how do you look at those topics and subjects?
yeah, for sure. As I mentioned earlier, I mean, at least for me, data center is a power play. So as you rightly said, power is a key thing. First thing, when you're going to develop a data center, you have what you call PUE, so power, which is like the utilization of power and also the efficiency of power, so power utilization efficiency, PUE, which is a pretty common metrics in the industry. The lower is the PUE, so the more efficient you are. And for instance, if you are in the Nordics where you have like natural cooling, also green energy, you may have like a pretty relatively low PUE. Where if you are like more like in warmer countries and with like potentially like more carbon fossil energy, you're probably going to have like more higher PUE. So that's a metric to make sure how efficient is your data center, how I would say they're going to be able like to consume potentially less energy. What we are currently working on is like, and it's very important for data center clients, is like to have those kind of sustainability features in order to consume less energy. Because by the way, if you consume less energy, you're more efficient, you can take more clients. So it means that in terms of returns and profitability, you're going to be more profitable. And so that's something which also works in both ways. But also we are trying to see a bit how we can optimize this energy consumption to get more clients, but also this is a request for our clients. If you take Microsoft, for instance, I mean, they have a long list of requirements. And if you don't,
Yeah.
if you're not green enough for them, they won't go in your data center. So that's why, I mean, you want to make your data center future-proof, not only
So
to
what
be more
does it mean,
profitable.
like a green data center?
So it means that, for instance, like you have like to have like power efficiency, which is a certain level. You need to be able like to use decarbonize power. So it means using renewable power, nuclear power, in order to show that you're not using high carbon features power. So that's important.
Hmm?
You need also, like for instance, like to understand how the cooling works. So for instance, like in our data center, we're doing like water loop cooling. So it means that the water is like being reused and there's no like escape of water. So that means water, I would say, consumption is a big theme also in the data center world, because you don't want like to be perceived as wasting some water, which is getting a more rare, I would say, commodity. You want also, like, for instance, in terms of the energy you're going to use, show like some kind of those kind of green efforts. For instance, like in a data center, we have what we call HVO fuel. So it means that we were recycling some oil, like for instance, your McDonald's chips oil. I mean, you put in a truck, and we're going to use those oil as a kind of backup energy. For instance, we're
Okay.
going to use also solar panel. So in our Manchester facility, we've put some solar panel. Okay, Manchester is probably not the most sunnier city in the
Sunny
world,
place.
but sunny place, yeah, exactly. But at least we are using a bit the facility, like, to make it a bit more green. One point that you mentioned is like heat reuse. That's something also, like, we've put in place in our new facility. Is that all the heat that's going to be produced? We have the possibility to give it for free to the local community, because there's some real estate programs who are kind of being developed around the data center. There's also a nursery. So the idea is to provide those heat, like, to the local community and give it back. This, for instance, you see in the Nordics, some large data centers, which are consuming a lot of energy, are also, like, producing a lot of heat, and we see, like, some heat recovery used for district heatings. In
Mm-hmm.
order to heat also local communities. So, I mean, this is happening. So, I think the fact that clients are looking for those kind of green credential push data center operators, like, to be more sustainable and put in place all
Mm-hmm.
those kind of energy efficiencies measures to reach those goals.
And do you think with the current energy mix or how it's evolving within the next like 5, 10 years, I mean, a data center will really be sort of carbon neutral? Because solar panels are great when there is sun, but I mean, I'm not an expert by all means, but my sense would tell
You need
me
much more
that
energy on.
during nighttime, it's a bit complicated to power the data center, which is something that needs to run like 100% of the time. So even with all of that, it seems that there is some sort of addition in terms of carbon rejection in the atmosphere in some way. So, but do you think that, you know, when you give heat to the local communities, it's essentially power and energy they won't have to use to essentially create that heat, etc. And do you have an idea on the net effect of those endeavor? Or?
Yeah, I mean, you're right. I mean, solar panels will not help too much on a data center, because consumption is too high and you don't produce enough heat. I mean, unless you need a lot of solar panels on your roof, or have like a kind of a
Mm.
solar panel facility next to where you are in a kind of pretty sunny location. I mean, that's tough. And you can say, like, you can argue you can have like battery storage in order to help during the night, but I mean, this is expensive. So I mean, you need to think economically. I mean, you cannot get all those kind of energy solution. Some are very expensive, like batteries. So it doesn't make a lot of sense, and the batteries won't last very long for a data center. So it's why, I mean, you need to find some kind of solutions, and often that you can negotiate some kind of PPAs, so power agreements with some kind of energy producer, and ask for this green power. So I mean, if you see Scotland, for instance, you have a lot of renewable energy.
Mhm.
You can, like, get those kind of green credentials, like, through green power. For instance, in France, you have a lot of nuclear energy. So I mean, this is like decarbonized energy. So you can expect to get something a bit more cleaner. What we currently see, and that's kind of a bit the future, is like a lot of hyperscalers are kind of worried that they won't have enough power for the large mega data centers. So what can you do? Uh, you read in the press that some are thinking, like, to get nuclear plants kind
Mhm.
of implemented near to the data center. So they're going to potentially build a data center near a nuclear plant. You have what we call SMR, which small modular reactors, which are kind of mini nuclear plants, which we believe could be start to be deploying around 2030, 2032. So it's not for now, but I mean, the people are working on the technology now. And this could be typically associated with the data center, where you have your own energy, which is cleaner than fossil energy. So this is potentially coming. Of course, this
Mhm.
is science fiction, so we don't know when and if it's going to really happen. But I mean, there's some strong there's a lot of money being invested in those kind of projects. One thing also which we see and having like regular discussion with energy players. I mean, those energy players have a lot of kind of sites where you could collocate to their sites where they have like some renewable energy. It could be wind, it could be solar.
Mm-hmm.
They could collocate a data center. So that's something also that is interesting because I mean, often they have the land, they have the grid access because we talk a lot about power, which is of course important, but the grid connectivity. So it means like the kind of cables who's going to connect your data center to the grid, and after the grid is
Yeah.
where the electricity is going to be connected. If you don't have a grid because you're in the middle of nowhere, good luck. Because some countries it's regulated, you may need to wait 3-4 years in a row, like, just to potentially have the grids connected. So that's something you need to, by the way, not only connected, but upgraded because you may have access to the grid. But because we are talking of a large amount of power, the grid could not be able to sustain so much power. So you have like solutions like
Mm-hmm.
microgrids. So you build your own network there. But I mean, it's what's happening in the US. But I mean, in Europe, it's a bit more complicated because, as I mentioned, it's like regulated. So everybody cannot build their grid like whatever they want. So I mean, there's some discussion also how we can upgrade the grids to make things happen. But that's kind of a big bottleneck for some
Mm-hmm.
of the data center to evolve. And by the way, it's maybe a good transition to this is that all the big numbers that you see in the press, like a lot of energy consumed like data center with large hyperscalers as clients. I mean, the big question mark that we have is that, is it possible? Because it's not that we have money, it's not a question of money. It's just a question of kind of, do you see some supply chain issues? And this is not something which is happening. So in order to build a data center, you need to have all the pieces. You need like to have the power that we mentioned, but I mean, you need to make sure that you have it. I mean, power, you can find it at some point, but I mean, if
Mm-hmm.
everything is happening at the same time, you might be like have an issue here. Do you have the grid to connect those kind of data center to the grid and to have access to this power? And do you have the people also? I think the lack of talent in the industry is something that we see because I mean, you need to operate those data centers, and there's a big like push to get those talents around. So,
Mm-hmm.
I mean, if you don't have the people too, not only to build the data center, which is one issue, but also to operate them, I mean, you're going to be a bit delayed. So I think that what may happen, what we may see is like kind of a bit of potentially some delay in all those projects or announcements, or potentially also we're going to see like, that's my view, also like some of projects are maybe to scale back and maybe start to go like grow progressively instead of putting big numbers and
Yeah,
after
what do you
not
think about
deliver.
like the sort of amount of investment in data centers at the moment? What if like models become in the next 2 years super efficient and they don't need so much data centers, and you essentially end up with massive amount of data centers that are sort of underused? There was like an article in The Economist talking about this a couple of days ago, where they essentially build a parallel with the railways in Britain in 1860s. Essentially, there've been some form of frenetic building of new railways way too fast, and they ended up with tons of dead and phantom and ghost tracks. Do you think that could potentially happen in that space? And if so, if you think, connecting to your first points in, identifying risk and trying to find mitigants, is this a risk you've looked at when you started your data centers projects in the UK? And if so, do you have a mitigants for that?
No, that's a fair question. I read this article and it is super fair. It's super fair because I mean, first, I mean, there have been cycles in the industry. I mean, and there's some kind of not such a long time ago, a lot of data centers bankrupt because of this kind of probably mismanagement of this. So, and when you hear those kind of trends here about data center, it's at some point looks a bit like the dot-com bubbles you had in the 2000s, where people were throwing around like big numbers, like things going very fast, a lot of money invested there. But at the end of the day, the models were not always like super well kind of thought. Here, I think AI is probably going to stay. Sometimes what's going to be the end impact question mark. And some of those articles say like, okay, how people is going to make money with this? At this stage, is still like a bit of kind of brainstorming on the business model. And it's why, I mean, it's very hard for an investor like to say like, oh, 100% convinced that's going to happen. I've got strong conviction that AI is going to change everything, and
Yeah.
the sky is the limit. I mean, as infrastructure investor, our role is also like to take a step back here. I mean, it's going too fast, too much money, too much inflation in price, etc. So that should be a red flag, because you don't want to have like kind of what we call a herd mentality and follow the herd because everybody's doing that. You should do
Mm.
that. This is part of our job, is like just pause, think, and say, okay, what makes sense, what doesn't make sense, what makes money, what doesn't make money, what do I understand, what I don't understand. And I mean, I think in our data center we've been very disciplined. For instance, like we don't build a new data center when we feel like most of the capacity is contracted in one facility, because we don't want to be exposed like to a market turn or kind of even overcapacity in the market, where we are left with some large data center with no kind of contracted capacity because clients are not there or clients kind of sold differently. And there was also like kind of those kind of articles, or do we need as much power in the future, or do we need to store as much data for AI, because I mean chips will be like more efficient, and they may need less learning, because I mean which means less learning means less data center like to do this learning, etc. So to answer to your question, one, probably is a bit of a bubble. How big it's difficult to assess. Second, I think as an investor, we would like to be disciplined, and we will not like speculatively like develop data center without any understanding or any contractual features. Or if you take development risk, you need like to have kind of a data center like next to it almost at full capacity. So you need, so you're going to use a bit like the cash flow of the contracted asset like to do like some development. So this is probably a risk that start to be acceptable. And you're going to do it by phase. I mean, all our data centers are done in 2, even 3 phases, where first we work on the first phase. We try to get clients for phase 1. And when we feel like phase 1 is well advanced, we can start phase 2. The good thing is like phase 2 is like still some CapEx to be invested, but there's some synergy between phase 1, 2, and 3, etc. So of course, you may have a better, I would say, if you feel that you're going to have clients very quickly, it's probably better to do all the 3 phases or 2 phases at the same time quickly, but that's increase your risk. On our side, on infrastructure, as I mentioned earlier, we try to have a defensive case and try to develop the alpha uh, on once the base case and the defensive case is well accepted and we have strong conviction on it. So that's a bit the way we would see it in terms of development of data center.
Okay. And so maybe like I'll ask you to take your crystal ball. So as an infra investor, you generally invest long term, so let's say 10 plus years. Where do you see the world of infrastructure in 10 years?
Yeah, no, that's a very fair point, and it's a very also complicated question, because I think we are at the corner of many changes. I mentioned the 4Ds, decarbonization, demographics, digitalization, deglobalization. So that's kind of global and trends are happening. I mentioned also like infrastructure connectivity. There's a bit of less and less frontier between power, digitalization, and mobility. And I think that's when you approach an investment in mobility, you need to understand digital, you need to understand power. Same thing when you invest in power or utilities, you need to understand digitalization, because you need to connect and distribute some energy between like different like end users, and also like when you're going to charge your company in EV, you're gonna like need to talk to other like EV charging points, but you also need to make sure you secure the power and have the right location. So I think this kind of infrastructure connectivity is going to develop more and more. And I think that also a lot of, for instance, of the maintenance is going to be more remote through sensors, and this is already happening. So I think if I'd like to have a crystal ball, I would kind of try to invest in those kind of adjacents of current like big infrastructure themes which have been there forever, and try to
Mm-hmm.
understand, okay, how those kind of big themes will evolve over time, how I can position myself. For instance, there's probably like a bigger push for electrification. So it means like, would gas still have sense? Probably yes, for some kind of very defined, I would say, usage, especially with the lack of energy. So I
Mhm.
mean, electrification. How do I do that? So do I need like to invest more like in the grid connectivity that I mentioned? Because we know that more electricity will require more grid connection, more granularity. So that's something we know is lacking. So I will look a bit at all those kind of gaps that we have in the infrastructure industry for electrification, for mobility, and for digitalization, and try to see how I can position myself now in order to be able to exit in 5, 8, 10 years, because I mean, funds in infrastructure are relatively long, and be able like to de-risk a bit those kind of technology and make them core when I think I'm going to exit in this amount of years.
Perfect. Listen, thank you very much for your time. I propose to end on that note. So Thibault, thanks again for being on Aulium. I hope to welcome you
Thanks very much,
again in
Thomas.
the near future.
Great. Thanks very much for your time again. Bye bye.